Greetings everyone and welcome. This is Neo and you're watching FinTech. If you enjoy our content, please do not forget to leave a like. You can subscribe and hit the notification bell if you want to be informed about our later videos. If you have any questions, you can leave a comment below. Before we start our video, let's hear our legal disclaimer. None of the information given in this video should be taken as financial advice. Please make your investments according to your own research. If you're following the crypto market closely, it's no surprise that the narrative in the West and narrative in the East can differ significantly. What I mean by that is, recently, the Western crypto market and technology industry in general has been dominated by this AI bubble. But there's a different story in the Eastern markets, and this AI bubble becomes a technology integrated into different kinds of innovations. And as you can see from the recent market movements, the S&P 500, for example, and Nasdaq recently broke below the key support levels, which was, well, unfortunate to say the least. And this ended the massive rally that we were having. And at the same time, we are seeing global institutional capital being rotated towards Chinese hard tech sectors where valuation remains significantly compressed despite strong growth. And when you are evaluating long-term growth opportunities, very few markets have a runway as large as China's. Because there is this combination of scale, manufacturing capacity, as we all know, domestic demand, and rapid adoption of new technologies. And all of these together create a foundation for multi-decade expansion. And the categories that we're talking about here are trillion-dollar categories such as AI, robotics, electric vehicles, battery technology, semiconductors, and industrial automation. And China is investing aggressively across all of them, positioning itself as a central hub, or they want to be the central hub for the next phase of global industrial evolution and thus markets. It is quite striking that many of these companies are growing revenue while trading at earnings multiples that are far below their global peers. What I can understand from all of these is a clear disconnect. You have strong R&D spending, robust balance sheets, and large market share positions, yet the multiples do not reflect the long-term potential. When a growth runway stays high while valuations stay low, that is where an opportunity usually starts forming. And this is particularly evident in the recent institutional shifts in the first 10 months of 2025. Foreign inflows into China's equity market reached, as you can see, $50.6 billion, which is a massive increase compared to the $11.4 billion seen in 2024. So there is a significant repositioning by global institutions who are trimming USD exposure to manage risk. You can find more data on this institutional positioning shifts at CHN Fund actually, but this is a Chinese website, so you may need to translate. But this is not the only platform talking about these kinds of changes and the potential. And to understand this, we can take a look at a specific example. The Rayliant ChinaAMC, which is Transformative China Tech ETF, CNQQ, serves as a really comprehensive tool. It tracks an index of more than 100 companies driving this innovation cycle, from AI infrastructure firms to robotics companies to EV manufacturers and biotech developers. This fund is a collaboration with ChinaAMC, which is the largest ETF manager in China and a major player globally, as you can see on their official website. The fund is a collaboration with ChinaAMC, which is the largest ETF manager in China and a major player globally, as you can see on their official website. And by blending A-share companies from the mainland with Hong Kong companies, the ETF ensures you're not playing on a single name. Instead, you get the whole network of transformative tech firms. And you can track the performance and see the full list of companies involved on CNQQ's Yahoo Finance page. And if you believe in China's continued innovation momentum, which we were discussing throughout this video, then the broad exposure makes more sense. Because then you're not trying to pick winners that would isolate your investments. Because the valuations are still compressed compared to the growth outlook, the risk rewards can look more attractive than in the markets where multiples have already expanded. Just to be clear, I'm talking about the potentials here. And a major factor currently driving interest is the shift in global monetary policy. On the 11th of December 2025, the Federal Reserve announced 25 BPS rate cut, as you know, creating a supportive environment for tech assets, as you can see. So we can say that the lower financing costs essentially extended the R&D runway for these firms. And we've already seen impact in specific sectors. For example, the lithium sector has seen a sharp rebound since, let's say, October, with prices rising over 60%. And companies like CATL, which is a major CNQQ constituent, are positioned to benefit. More details on fund strategy can be found in Rayliant's official announcement. So what we're talking about is policy decisions, currency swings, and changes in consumer behavior. That is why an ETF structure can help. It basically spreads exposure across more than 100 companies instead of concentrating everything into one stock. For an objective look at the risk and ratings associated with this growth, you can look at Morningstar actually, which provides a detailed analysis. And CNQQ at that has started to become talked more and more because it's a US-listed ETF that gives investors exposure to over 100 next-generation Chinese companies, including AI, semiconductors, smart manufacturing, EVs, and healthcare innovation, as I've mentioned. And the ETF has actually seen support from the Fed's December 2025 rate cut, which helps tech companies with financing and boosts valuation at the same time. And big names like Alibaba, Tencent, Cambricon, Baidu, and CATL, as I've mentioned, have recently posted strong gains, and foreign institutions are increasing their Chinese tech holdings. And actually, if you want, you can track CNQQ on Yahoo Finance, check the official Rayliant announcement, as I said, and you can see the ratings on Morningstar. So the bottom line is quite simple. China has one of the strongest long-term tech runaways in the world, and the valuations are still low compared to the Western counterparts. And CNQQ is one of the options that packages the entire theme into a single ETF. If you want to keep an eye on how these trends develop, Rayliant's official X account is a good source for updates, and you can see the news on many major outlets. I linked them all down in the descriptions of this video. Before we close, this video is a part of a paid collaboration, but I don't work with sponsors that does not align with the research I already cover in this channel. This video is part of a paid collaboration. I only work with the sponsors that align with the research I already do for this channel. Nothing here should be taken as financial advice, and you should always do your own research before investing. That's all for this video. We'll continue to bring you the latest news and promising projects. Stay tuned. Thank you for watching FinTech. Until next time.